let's turn our attention to the Fed. Yes, the Fed meeting today, lost in all of this discussion. We aren't expecting a significant change, at least in interest rates. But let's bring in Gibson Smith Capital Investors founder and chief. And Gibson, let's sort of try to tie the two conversations together here, because so much of the conversation around the markets rallying was about just the sheer amount of liquidity that was in the markets because of the Fed. And now we're talking about a whole nother dynamic coming into play. Just curious what you make of the discussion that is playing out.
Well, we live in times where there's a mass amount of liquidity in markets. We've had very loose monetary policy. We've had an enormous amount of fiscal stimulus. There's a massive amount of cash on the sidelines. And when capital is cheap, speculation goes up. And we're seeing that playing out. And some of the stories, obviously, they may be aberrative in nature, but I think they're a reflection of a lot of capital chasing returns. One of the outcomes of the unconventional monetary policy, which is becoming more conventional by the day, is the low yield environment. So again, cheap capital. And I think they are interrelated, albeit maybe a GameStop or an AMC or another stock that goes up hundreds of percent in one day is just not reality, and that's not the way that healthy markets should be functioning.
I don't know. It's interesting to watch it all play out now, because you had the VIX popping quite a bit above 28. I mean, the spillover effect of this. Try and connect the dots for me, because you could say you're not used to seeing pops like these in names like these, but I mean, obviously, some of these were dealing with some serious bankruptcy risks. When you look at an AMC, you get those answers, then it seems like a switch is flipped. How does it carry over into kind of maybe the animal spirits that investors are applying to other completely unrelated securities out here? Walk me through that.
Well, when markets are pricing in kind of a high probability of bankruptcy, clearly you see depressed stock prices, and then you see depressed bond prices. Some of these companies have actually come in and done refinancings in the high yield market that has given them a lifeline. We've all talked about the zombie companies that exist that may not have great fundamentals, but underlying those bad fundamentals may be some liquidity that gives them the opportunity to fight for another day. And some of that is playing out. Companies come in, they do bond deals, they raise liquidity, the stock pops, the shorts get squeezed. That's the tie-in. When you bring the VIX into the conversation, it's really interesting in that equity volatility as measured by the VIX has a direct impact on the credit markets, which are providing all of this liquidity and fuel for companies. And there's a definite relationship. As the volatility goes up in equities, we tend to see more volatility in credit spreads and thus higher borrowing costs for companies. So there's a direct tie-in. I throw out one other thing. Just remember also that we're in kind of, I would say, stretched valuations across markets. You have very high equity valuations, you have very low yields, and you have this consensus view that stocks are going to go higher, yields are going to go higher, and the economy is going to accelerate. And those things, if they are challenged, will ultimately lead to more volatility and maybe some more, shall we say, spread widening in the credit markets or more volatility in the equity market.
Gibson, let's talk about what you are anticipating to come out of this Fed meeting, because it does feel like the economic data has continued to point to some slowing in the economic recovery. We've also got a stimulus package that was passed in December, a $1.9 trillion one that is being debated currently on the Hill. How do you think that changes the outlook for the central bank at a time when we have seen repeatedly or heard repeatedly from Jay Powell saying we've got to have the fiscal come along with the monetary?
Yeah, if we think about the last 20 years, we've been in an environment where fiscal policy and monetary policy have been at different ends, or they've been in conflict. And we're now in an environment kind of because of COVID, where you have fiscal policy and monetary policy working hand in hand. And that's obviously a very big influence on markets. Markets are discounting mechanisms and getting front of the economic growth. I think when you look at the last 5 recessions and you look at the economic data coming out of them, you do have fits and starts. It's not a one-way shot. It takes time. People have to get back to kind of normal operating abilities and so on and so forth. So I think the economy is actually doing quite well. I do think it's going to do better going forward. The real question for Janet Yellen, and congratulations on our first female U.S. Treasury Secretary, which is just fantastic. But the real question for her is going to be, when does the Fed take their foot off the gas? When does the Fed decide to start easing on its two policy positions of quantitative easing and or low interest rates. And I think the market's watching for any commentary around potentially shrinking the balance sheet or stopping the quantitative easing. I don't think she's going to do anything. I think she's going to be kind of business as normal, keep moving forward, let the recovery take hold, and ultimately markets are actually going to probably reward any positive commentary out of her today.
Yeah, it does seem like she's kind of been on the same page so far, at least as Fed Chair Jerome Powell. But we will see what updates we get. Gibson Smith, Smith Capital Investors founder and chief investment officer, appreciate you joining us.